In 1913, America handed control of its money to a network that was neither fully public nor fully private. A club so powerful, its decisions ripple through every global market. Behind locked doors, 7 men drafted its secret blueprint on a remote island. Ever wondered why the world's most important money machine isn't run like any ordinary government office? The answer begins with the creation of the Federal Reserve, and the consequences still shape every dollar in your pocket. The Panic of 1907 sent shockwaves through Wall Street as banks failed and depositors lined up in fear. With no central bank to steady the system, private financiers like J.P. Morgan scrambled to organize last-minute rescues. The crisis exposed a dangerous weakness. America's financial future hinged on the fortunes of a few powerful men, not on any public institution. In November 1910, Senator Nelson Aldrich gathered a secret group of bankers and Treasury officials at the secluded Jekyll Island Club. Disguised as a hunting trip, they drafted a plan for a new central bank, one that would blend private banking expertise with a measure of public oversight. Their proposal, shaped by months of closed-door debate and fierce public distrust, finally reached President Woodrow Wilson's desk. On December 23, 1913, Wilson signed the Federal Reserve Act into law, launching a hybrid system designed to balance Wall Street's influence with government control. The resulting structure was unlike any other in the world. At the center of the Federal Reserve System sits the Board of Governors in Washington, D.C. 7 members serve staggered 14-year terms, each appointed by the President and confirmed by the Senate. This board holds national authority, but the real reach of the system stretches across the country. 12 regional Federal Reserve banks, each based in a major city like New York, Chicago, or San Francisco, operate as private corporations. Local commercial banks are required to buy stock in their regional Fed. This stock is unlike any other. It is non-transferable, it pays a fixed dividend capped at 6%, and it grants no control over profits beyond that set rate. Instead, most earnings are returned to the United States Treasury. The regional banks manage day-to-day operations, while the board sets broad policy and supervises the system. This blend of private ownership and public oversight was designed to keep power from concentrating in any single group's hands. Every day, the New York Fed's trading desk quietly moves billions with a few keystrokes. Here, the Federal Reserve's real power unfolds. It does not come from printing bills, but from creating digital reserves that ripple through the banking system. When the Federal Reserve wants to inject money, it buys Treasury securities from primary dealers. The bank's reserve accounts at the Federal Reserve are instantly credited, expanding the base of money banks can lend. This process, called open market operations, is the first tool in the Federal Reserve's toolkit. During crises, the Federal Reserve turns to quantitative easing, buying assets on a massive scale and swelling its balance sheet, like in 2008 and in 2020, when reserves shot from under $1 trillion to nearly $9 trillion. Banks can also borrow short-term cash through repurchase agreements or repos, adding temporary reserves. Since 2008, the Federal Reserve pays interest on reserve balances, setting a floor for overnight rates. In this world, reserves exist as numbers on a screen, fuel for lending, but never seen by the public as cash. When Lehman Brothers collapsed in September 2008, panic swept through global markets. Over a single weekend, Ben Bernanke and his team at the Federal Reserve scrambled to prevent a total freeze of the financial system. Emergency lending facilities opened their doors, pumping hundreds of billions into banks and money markets. The Fed's balance sheet more than doubled as it bought mortgage-backed securities and treasuries, injecting digital reserves on a scale never seen before. By the end of 2008, reserves had soared from under $1 trillion to over $2 trillion. 12 years later, another crisis struck, this time a pandemic. Within days, Jerome Powell unleashed a new wave of interventions. the Fed rolled out programs for everything from corporate bonds to small business loans, and the balance sheet ballooned to nearly $9 trillion. Each action rippled far beyond Wall Street, shaping the flow of credit, jobs, and savings around the world. In moments of crisis, the Fed's toolkit can redraw the map of the real economy. In 2013, a single announcement from the Federal Reserve sent markets into turmoil across continents. When Chairman Ben Bernanke hinted that the Fed might slow its bond purchases, investors around the world scrambled to pull money from emerging economies. India's rupee plunged nearly 20% in a matter of weeks, while bond yields in countries like Brazil and Indonesia spiked sharply. The dollar's role as the world's reserve currency meant that even a subtle shift in U.S. monetary policy could trigger capital flight and currency shocks thousands of miles away. For many, this episode revealed just how far the Fed's influence truly reaches. Critics call the Federal Reserve a private club, pointing to its regional banks and member stock as evidence of Wall Street's grip. They question whether the system favors big banks over the public, raising concerns about democratic oversight. Defenders argue that independence shields the Fed from political pressure. Paul Volcker's decision to raise interest rates above 20% in the 1980s stands as proof, they say, that only an insulated central bank can make the tough calls needed to protect the economy. Every Federal Reserve decision today reverberates through global markets and household budgets. As digital currencies rise, who shapes our money and who benefits matters more than ever. What is your take? Drop it below.